Let's face it, algorithmic trading is hard and not everyone wants to spend their time building trading systems to boost their investment portfolio. That is how copy trading services came about, to cater to the demand of those busy investors who are still savvy enough to chase outperformance with alternative solutions. However, piggybacking on someone else's trading strategy is not as straightforward as paying the subscription fee and hooking up your trading account to it. There are many pitfalls, some fundamental and most of them technical, that are far from obvious when you start, and that will end up causing you at least some disappointment and at most a lot of money. So in this video, I have prepared for you a 7-point checklist to weed out the guesswork and have you finally maximize your copy trading experience. Let's get it. So, without any further ado, let's jump into mistake number 1, not reading the system description. It is an obvious fact that most potential subscribers are drawn to a particular strategy because of how pretty its equity chart looks, but that is only a small portion of a strategy's true picture. Knowing this all too well, most copy trading websites have made room for the system providers to add a brief or an extended description of how their strategy operates under the hood. Without disclosing the proprietary logic or the code of the algorithm itself, the description is typically expected to unveil its return target in terms of aggressiveness, with what type of trading style it plans to achieve it, using what specific markets and instruments, and by implementing what scale of risk management. Right off the bat, this section alone should be very telling. A lousy description, or one that does not cover these 4 points, should immediately raise red flags. There is absolutely zero reason for a system designer to remain evasive, blurry, or dismissive about the core logic of their strategy. Additionally, you will find that a few serious system providers like FX Physics will take the time to provide either a link where in-depth details can be found, or will offer you the possibility to request a backtest with vital statistics or to download a fact sheet straight from their website. Essentially, the more transparency, the better. Last thing I want to point out is, in some odd cases, and as crazy as it sounds, the description itself will give out that the provider does not know what they're doing and that the strategy will be doomed long term. I have a real life example of that for you guys. Right when Collective 2 started accepting Forex systems in its database a few years back, I remember this one provider coming in and declaring in the description that their Forex system will quote-unquote only trade long in order to take advantage of the mean reverting bias of this market. If you have followed this channel for long enough, you should be absolutely horrified by what I just said. Needless to tell you that I already knew what this strategy would end up. I could have been sassy about it, subscribe and intentionally take the opposite trades just for fun, but I had better things to do at the time. Regardless, a few months later, I came back to check the system out, and without any surprise, its equity had gone to zero, having taken for the ride a plethora of unsuspecting subscribers who either didn't care about reading the description or didn't know better. So I'm telling you guys, read the damn description and ask questions before subscribing. Any system designer worth its salt will be more than happy to guide you through the features that you will be paying for. Next, number 2. Correlation stacking. As I mentioned it a minute ago, a pretty equity curve shouldn't distract you from the fact that stacking returns upon returns will do no good to your allocation if you are also stacking correlation. What do I mean by that? Just like I showed you extensively in this video, what I mean is that investment performance is not returns. Performance is risk-adjusted returns, and the only way to achieve that is through decorrelation. So you need to consider each strategy like an asset class in itself, meaning that regardless of their rate of return, each strategy that you subscribe to should be doing at least something different and possibly opposite to most others in order to achieve the correlation. For example, in case you're already trading long equity futures yourself, you might want to subscribe to a strategy that trades volatility or long short energy futures or even Forex. In other words, you need to build your portfolio like a Lego, where each brick essentially keeps the castle upright anytime one of them temporarily fails. Strategies should be relaying each other during downturns and do something completely unrelated in order to achieve maximum decorrelation. And obviously, a way to achieve this ties directly into reading the system's description. By the time you are ready to subscribe, you should be able to answer the question, how does this system strategically improve my overall asset allocation and its long-term risk-adjusted return? Now, number 3 is a bit sneaky, but it could save you a ton of disappointment. You see, most subscription services are one and done, meaning that once the subscription payment is made for the month, there is no canceling or even prorating it to how many days you actually used it for. And finding out that you cannot trade a particular strategy can be totally annoying. So what do I mean by that? I am talking about the fact that some strategies might be trading instruments that government regulation forbids you to trade in your jurisdiction, and it is your job to evaluate before you subscribe whether all or part of the strategy can be traded at your brokerage. For example, EU retail customers typically cannot trade US ETFs without being reclassified as professional. Some countries like Japan have banned forex trading altogether, or some others have imposed drastic restrictions on cryptocurrencies. So you have to be aware of this and do your due diligence ahead of time. System providers are just that, system providers, and they are not supposed, nor liable, nor allowed to tailor their offering to your particular legal or tax situation. Number 4, and that's a biggie, stop getting lured by high returns. I know you can't help, but you need to snap out of it. I'll take Collective 2 as an example here again. Those systems with the largest following are consistently the ones with the largest short-term returns as opposed to long-term robustness. Guys, stop doing this to yourselves. You're like moth attracted to a flame, and every time you get burnt and wonder why. What you need to remember is that no matter the winning streak that a system can be on, it will be extremely hard for it to maintain a MAR ratio of 2 or even 1 long term. So if there is a 50% annual return so far with a 10% drawdown, you can be pretty sure that unless the system is in the 0.01 percentile, it will experience a 25 to 50% drawdown at some point. And to make matters worse, most people who subscribe to this type of system will not do it when it is in a drawdown, but rather when it just hit a local peak, thereby maximizing the likelihood of a short-term loss. So just please be sensible about what you're doing and stop chasing the next shiny object. Instead, look at those systems that have stood the test of time and are battle-tested for going through and surviving multiple market crashes. Any trader can be lucky for 6 months to a year, so stop gaslighting yourselves. Moving on to number 5, a sneaky one, but a very troublesome pitfall if you're not careful. Can the system be adversely impacted by liquidity crowding? Said differently, if too many subscribers flock to this system, will the instruments traded by the strategy offer sufficient liquidity to shield the subscribers against the risk of slippage and degraded performance? That is extremely important. Let me give you 4 very specific examples here so that you know what to investigate. Example number 1, illiquid futures. Trading S&P 500 futures is usually very liquid and no concern. But what about if the system trades some odd commodities contract? As you will learn it, copy trading platforms are usually forced by the CFTC to impose a random time delay in futures trade execution for its subscribers in order to spread out the impact of a trade on the market. That can, in the long run, impact your performance adversely if the main contract traded by the system happens to be an illiquid one. Example number 2, stock trading limit order execution. Limit orders usually are a great thing in order to delete the possibility of slippage. However, with equities, including liquid stocks of the New York Stock Exchange Index, limit orders are not always filled on the spot once the limit is reached. In other words, the price can hit the limit of the system, and yet not all subscribers can be filled immediately. Whenever that happens, copy trading platforms usually enforce the conversion of your limit order into a market if touched order, basically turning your limit order into a market order in case the spot price just pinged your limit without giving you a fill. That will typically result in slippage and therefore under replication of the benchmark system that you are subscribed to. Example number 3, penny stocks. Need I say more? Replicating penny stock trading performance is exceedingly illusory because of the non-standardized and usually extremely thin liquidity of OTC markets. It is not uncommon to see slippage regularly in excess of 10% in these markets, and that alone will instantly destroy any hope of profitability. So in general, and as a rule, it is better to steer clear of trying to replicate anyone trading these markets because in all likelihood, there will be just enough liquidity for them, if that, and none left for you. And in the worst nefarious cases, you might also be used as exit liquidity once the pump has been fueled by the subs. So whenever you detect trading in penny stocks, your best bet is to abort mission. And finally, example number 4, forex scalping. Once again, extremely hard to replicate. Why? For 3 reasons. The first reason is that unless trading happens on a very liquid pair like euro-dollar, slippage will be very frequent and costly. Realize that a few fractional pips of slippage can and will turn a basic scalping strategy from a winner for the trade leader into a loser for the subscribers due to the very tight profit expectancy. Second reason, there is no such thing as a proper limit order in Forex, no matter how your broker or trading platform labels it. All the so-called limit orders in Forex are in fact market if touch orders, which means slippage will occur. Third reason, the price is not always the price in Forex. Because of the decentralized nature of this market, each broker usually has their own price feed, which will differ marginally depending on the banking counterparties that they work with to supply liquidity, as well as because of the minimum spreads, which can and will vary. So unless the Forex strategy targets in excess of 15 to 20 pips per trade, you better be very careful with what you wish for. Next up, number 6, a very important one again. This is common sense, but you would not believe how many people overlook this one. It has to do with the subscription fee itself. Does it even make sense considering the size of your account? Let's say, for example, that the monthly subscription fee is $100 and that your account is $10,000. Does it even make economic sense for you to pay 12% of your account every year to follow that system, no matter how profitable it is? Of course, in order to make an even more accurate assessment of whether or not it does make sense, you should definitely ask the system provider what the expected rate of return for the strategy is per annum. The provider should be able to give that to you based on the long-term backtest that they should have on hand. So let's assume that the strategy is expected to generate 20% per year. As you can see, paying a 12% fee annually makes 0 sense, as it would wipe out 60% of the expected performance that you're paying for. This is an extreme example here, but you get the point. So please exercise common sense. And lastly, point number 7, and that is one that I have observed way too many times as a system provider myself. I'm talking about subscription hopping. What is this? I am talking about subscribers compulsively jumping from one strategy to the next to chase the next hot thing and usually getting in and out at the worst possible times like they would typically do trading single stocks. Actually, let me show you a real and tragic example of what I've witnessed firsthand. Let's take Alchemy here. In 2024, Alchemy had a stellar start, generating almost 30% in the first 4 months. Obviously, that attracted subscribers, most of whom got in at the top, of course. Without fail, after that slew of subscriptions, the system experienced a drawdown, like any system will. What do you think happened then? Of course, the subs unsubbed at the worst possible moment, literally between here and there on the chart. I'm not even kidding you. And what do you think happened right after? The system rebounded sharply to new highs literally the next month. I mean, you couldn't make this stuff up if you tried. In fact, you could probably trade it. Look, I am not throwing shade at my subs. At the end of the day, we all make mistakes and this is your money. You do you. But this is excruciatingly painful to watch people hurt themselves with the same backwards investment behavior again and again. So for all intents and purposes, let me remind everyone here that there is no such thing as instant gratification in trading or in anything for that matter. You need to be able to stay the course with the system that you subscribe to, at least for 6 months. Now, I obviously do not advocate for following a system forever if it keeps on losing, but you get the general idea here. And to help you make the proper assessment as to when to actually bail, just like I told you to ask for the expected return from the system provider, I am telling you to also ask for the expected drawdown. That way, you will know ahead of time what to expect. You will stop freaking out whenever a system's drawdown hovers well within its average expected breathing room, and you will keep yourself from shooting yourself in the foot with the worst possible timing. So this is it. As you can see, copy trading is not nearly as easy as copy and paste. There is some due diligence to do beforehand, and I hope that this quantitative trading tutorial will help you maximize your experience and your gains in this exercise. If you have any questions or copy trading feedback to share, please feel free to do it in the comment section below. As for me, I will wrap it up here, and I'll catch you in the next one.